Welcome, guys. Thank you very much for joining today. I really hope you guys are doing well, and I hope you're looking forward to the Meta Q2 earnings report like I am. So that's exactly what we're going to do today. So, Meta is going to report its quarter two 2026 earnings in about 10 to 15 minutes. So, what we're going to do today is just see the results, give our reaction to it, and just talk about the earnings report. So, specifically, we're going to take a look at some news as they come out for the earnings report. We're going to take a look at the chart and the price of Meta stock in the after hours session to see how it's reacting. And after that, around 4:30 p.m., they have a live earnings call. So we're going to listen to that when it comes up around 4:30. So we got some good stuff to take a look at today. Before we jump into all of this and get started, I would like to mention that on my YouTube channel, I create content about sports, money, and personal topics with the goal of bringing value to your life. So if you find value in this video and in this show, go ahead, subscribe to my YouTube channel so that I can continue making these videos. Also, hit that like button and make some comments on your reaction to the Meta earnings results. All right, so I think the first thing I want to take a look at is see what Meta stock is up to at this moment. So let's go ahead and take a look at that. All right, so just before we take a look at Meta stock, because the market is about to close in about 8 minutes. So today, the Dow Jones is down over 800 points, down 1.5%. So let's just look at it for a moment. Down day today for the Dow. Pretty flat over the past month. It's been around in that 51,000 range. It's doing pretty well over 1 year, up over 15%. 5 years, it's up 47%. So the Dow Jones Industrial Average is doing good, other than the fact that today it's down a little bit. But let's take a look at the next major average, S&P 500, down 1.3% today. Over 1 month, it's pretty flat. 1 year chart, the index is up 15%. Over the past 5 years, it's up 66%. And let's take a look at the NASDAQ, the one that we're interested in because it's tech heavy. All right, the NASDAQ is down 1.5% today. Over the past month, it's down 5%, so that's pretty significant. 6 months, up 3%. Over the past year, it's up 16%. And over the past 5 years, it's up 67%. So the major indexes are doing pretty good. Just having a negative day today, which is normal. And we'll see if Meta's results will change that for those indexes in the coming days. So let's go ahead and now take a look at Meta. All right, so 5 minutes before the market close, Meta is trading at $583.39, down over $10, down almost 2%. So it was doing pretty good, or better, just about an hour ago, but it's gone down in the last hour or so. All right, so let's take a look at the 1-year chart for Meta. So 1-year chart, the chart shows that Meta is down 16%, down over $100. So last July, the stock went up after looks like a good earnings report, up to $740, $750. But since then, it's just kind of trickled down and stayed in the 600 range on average. So earlier this year in January, as the first report came out of this year, the stock went up back up to $740 here in January. But since then, it just kind of trickled down all the way down to the low 500s, but then it went back up to the high 600s. So it's just been in that, $500 to $700 range this past year. And it was up here as much as $680, but it's gone $100 down since then to the 580s. So it's been a bit of a volatile stock this past year. Not the prettiest looking 1-year chart, but we'll see if that changes today. Let's take a look at the 5-year chart. So this looks a little better. So since the stock bottomed in end of 2022, the stock was under $100. It was around $90. It continuously went up all the way up to $740 here in February of last year. And then we had the tariff situation in April of last year, brought the stock back down to the $500 range. And then since then, it's gone back up to, again, $740, $750. and then stayed in that $600, $700 range since then. So very, very interesting earnings report is about to come out. And we'll see what happens. All right, let's take a look at the max chart. So looking at the max chart, the all-time high for the stock was around $790. So we're about $200 away from that. And we are here. So again, very, very interesting earnings report about to come out. It's 4 p.m. The stock market just closed. So we'll just wait patiently as the earnings results come out. We're going to try to find some good news as they come out. Yeah, so the 52-week high for the stock was $796. 52-week low, 520. So we're at 580 right now. So we're closer to that 52-week low, obviously, than the high. But things can definitely change. All right, stock market is closed, but the stocks are still trading in the after-hours session. So we'll see how much Meta changes in the after-hours session. The results should be coming out any minute. So the stock market is down today because the Fed decided to keep interest rates unchanged. So investors were hoping that maybe they would lower their interest rate even more, but they decided to keep it unchanged. And because of that, that's causing a bit of a sell-off in the market. All right, let's take a look at CNBC. All right, so on CNBC in the after-hour session, Meta is down another 6.5%. So we'll just be patient and see what exactly happens. All right, Meta Platforms revenues beat. Revenues came in at 60.8 billion versus 60.17 billion. Earnings per share miss. They came in at 6.18 versus 7.22. CapEx increased from 130 billion to 145 billion, up from 125 billion. Q3 revenue outlook is 61 to 64 billion versus 63.15 billion expected. So the earnings per share missed, but the revenues did beat. So the stock is down another 9% in the after hour session right now. All right, so far, maybe not the best earnings report by Meta. Stock is at $542 at the moment. So I think it's a bit of a disappointing earnings result. I personally was hoping that Meta would pop upward very nicely after this earnings report, but that's not the case. All right, let's check out MarketWatch. See if there's anything useful on here. Let's actually just go back to the CNBC page. I think it's the best one. So the stock is recovering a little bit now from the initial dip. So we'll see what the earnings call has. If Mark Zuckerberg has any other good information. All right, what want to do next is take a look at some charts for Meta and discuss that while we take a little break from watching the share price. So we have these three charts right here. As they say on the left-hand side, the first chart is the stock price. The second one is net earnings per share. And the third chart is the PE ratio. So what I want to talk about is the PE ratio, the bottom chart. So right now, Meta's PE ratio is 21.58. And that's a bit lower than previous ones, which were 28, 32, 26, 22, 24, and so on. So right now, Meta's stock price, is a bit cheaper than previously. So its forward price to earnings ratio now is lower than it has been on average, which means the stock is a bit cheaper now than it is on average. So, it might be a good entry point to buy the stock in the 500s, since there's a good chance that the share price will go up and get back to a higher price to earnings ratio. So this chart basically just shows that the stock is a bit cheaper now than it has been in recent months and recent years with the lower PE ratio. So stock looks a bit cheap right now. We can see the earnings per share growth over the last few years, the stock price growth over the past few years. So all right, let's go back to Google Finance to see what we have on there. All right, so Meta is at around $558 right now, down 4 to 5% in the after-hour session. So it was initially down even further, around $540, but it has recovered nicely in the last 5 to 10 minutes. So I think overall a little bit of a disappointing earnings report, but still an amazing company, amazing results. Just the expectations were really high. Also, Microsoft reported its earnings as well. Their stock is up around 1.5%. So that's good to see for Microsoft investors. All right, let's go back to CNBC, see if we can find some news that dive into the Meta earnings. All right, so we have on here Meta stock drops on earnings miss, light revenue guidance. Meta stock drops on earnings miss, light revenue guidance. Key points: Meta shares dropped over 7% on Wednesday after the company reported second quarter earnings that missed on earnings per share. Meta said it expects revenue this quarter of between $61 and $64 billion, or $62.5 billion at the middle of the range. Analysts were expecting guidance of 63.15 billion. The company said that the guidance assumes foreign currency is an approximately 1% headwind to year-over-year total revenue growth based on current exchange rates. Yeah, so the expectations were really high for Meta for this quarter. So let's keep reading through here. So Meta shares dropped over 7% on Wednesday after the company reported second quarter earnings that missed earnings per share. Here's how the company did compared with estimates from analysts polled by LSEG. So Meta reported earnings per share of $6.18 per share. The estimate was $7.22. So that's a pretty big miss on earnings, a miss of over $1. So that's not the result that we wanted to see, but revenue did beat. Revenue came in at $60.8 billion versus $60.17 billion. So Meta said it expects revenue this quarter of between $61 and $64 billion, or $62.5 billion mid-range. We mentioned analysts were expecting guidance of 63.15 billion. So basically Meta missed on earnings per share and on the revenue guidance for this quarter. The company said, so we mentioned that already about the foreign currency. The company said that daily active people, or DAP, came in at 3.6 billion, trailing Wall Street estimates of 3.61 billion. For capital expenditures, Meta narrowed its guidance for the year to between 130 billion to 145 billion, from a prior range of 125 billion to 145 billion. So that's a really important number there, the capital expenditures. So there was 130, or it was 125 to 145. They narrowed it, but it went up from 130 billion to 145 billion. So I kind of think that's good results, just because I think there was some fear that its capital expenditures were going to go up even more in this quarter. So the fact that it's still within a very close range, I think the capital expenditures, they're basically in line, they're manageable. So I think that's a really good number to see as well. And on the earnings call, investors will be listening closely to what Meta CEO Mark Zuckerberg has to say about the company's efforts to more directly monetize its various AI-related efforts. Earlier this month, Meta debuted the Muse Spark 1.1 model, which the AI chief said it was the strongest model for agentic and coding work yet. So we're going to jump into that earnings call in about 10 minutes when it starts. So let's just keep reading through the news here. All right, so still the stock is down 5% in the after hours session. Yeah. Yeah, I mean the expectations were very high and the company did not meet the expectations on a few of the metrics. So the stock is down the extra 5%, but it should recover in the coming days. So not the jump that I was hoping for in Meta, but still really good results big picture wise. And it might be a good buying opportunity in this range in the 500. So all right, let's go back to Google Finance to see if there's any news that comes out on here. And then we're going to jump into the earnings call. So see what we find here. All right, let's just read a little bit through this article, see what it has. Meta reports second quarter 2026 results. Menlo Park, California, July 29th, 2026. Meta Platforms today reported financial results for the quarter ended June 30th, 2026. AI is accelerating our core business today, powering our next generation of products, and opening the door to entirely new enterprise opportunities, said Mark Zuckerberg, Meta founder and CEO. The results are already showing, and I'm optimistic about the potential ahead. So let's take a look at the second quarter 2026 financial highlights. All right, so we mentioned revenue came in at 60.8 billion. This time last year, it was 47.5 billion. So revenues increased 28% year over year. Costs and expenses, 42 billion versus 27 billion last year. at this time. So that is a big number. The costs and expenses increased 55%. And earnings per share came in at 6.18 versus 7.14 last year. So a decrease of 13% on earnings per share from the same quarter a year ago. Second quarter 2026 operational and other financial highlights. Daily active people, 3.6 billion, an increase of 3% year over year. Ad impressions delivered across the family of apps increased by 14% year over year. Average price per ad increased by 12% year over year. Revenue was 60.8 billion, an increase of 28% year over year. I mentioned the costs increased 55% year over year. So that's that capital expenditures. Just mentioned that. Let's see if there's anything else interesting on here. Headcount was 75,472, a decrease of 1% year over year. CFO outlook commentary. So they say we expect third quarter 2026 total revenue to be $61 to $64 billion. We mentioned 2026 capital expenditures. They expect it to be 130 to 145 billion. Previously, it was 125 to 145. All right, guys, I think it's good enough as far as the information. Next, we're going to jump into the earnings call for Meta. It starts in a couple of minutes here, so just want to get that up and ready. All right, we're just going to wait patiently for the Meta Q2 2026 earnings presentation. So Meta's results were a bit disappointing. The stock is down in the after-hour session, so hopefully we get some good information here in the earnings call, and maybe the stock might reverse. So welcome in, guys. Thank you for joining me. So the earnings call should start any moment now. If you guys have any questions, feel free to put it in the chat.
Ladies and gentlemen, this is the operator. Today's conference is scheduled to begin momentarily. Until that time, your lines again will be placed on a music hold. Thank you for your patience. Okay, back into a private mode. Amy, waiting on your begin. Okay, so we are going to go live momentarily. There will be a brief pause as we start the webcast. I'll begin my introduction and turn the call over to Mr. Heaton. As a reminder, your lines are open and anything that you say will be heard into the main call. Are we ready to begin?
We are ready to go.
Thank you. There will be a brief pause as we start the webcast. Please stand by for my scripting. Good afternoon. My name is Krista, and I will be your conference operator today. At this time, I would like to welcome everyone to Meta's second quarter 2026 earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question, please press star, then the number 1 on your telephone keypad. To withdraw your question, again, press star 1. We ask that you limit yourself to 1 question, and this call will be recorded. Thank you very much. Chad Heaton, Meta's Vice President of Finance, you may begin.
Thank you. Good afternoon, and welcome to Meta Platforms' second quarter 2026 earnings conference call. Joining me today to discuss our results are Mark Zuckerberg, CEO, and Susan Li, CFO. Our remarks today will include forward-looking statements, which are based on assumptions as of today. Actual results may differ materially as a result of various factors, including those set forth in today's earnings press release and in our quarterly report on Form 10-Q filed with the SEC. We undertake no obligation to update any forward-looking statement. During this call, we will present both GAAP and certain non-GAAP financial measures. A reconciliation of GAAP to non-GAAP measures is included in today's earnings press release. The earnings press release and an accompanying investor presentation are available on our website at investor.meta.com. And now I'd like to turn the call over to Mark.
All right. Hey, everyone. Thanks for joining today. We had a strong quarter for our community and business with 3.6 billion people using at least one of our apps each day. We reached several milestones. Instagram reached 2 billion daily actives. Threads crossed 500 million monthly actives, making it the fastest growing conversation app ever. Facebook has reached more than 2 billion daily actives for a while now. WhatsApp just hit an all-time messaging record, peaking at 30 million messages sent per second during the World Cup final. And also, Kunal Shah just joined as our new head of WhatsApp. He built one of India's most important payment companies and will be a great addition to the team. We also shipped some strong new models from Meta Superintelligence Labs and released new glasses. Overall, the scale and reach of our community across our apps is pretty remarkable, and it gives us a strong platform for delivering new innovations to billions of people. The opportunity in front of us is massive. First, we are now at a point where our investments in AI are accelerating every major part of our core business. They're improving the experience for people using our apps, driving better performance for advertisers, and helping our teams build new experiences and ship faster. Second, we are developing new personal agents that will be the foundation for our next wave of products and revenue lines in the months and years ahead. And third, we see a large enterprise opportunity to sell to businesses, including APIs, business agents, potentially selling compute directly, and other services that we're building for large customers. And I want to spend some time today laying out exactly how our investments are delivering results today and the opportunities that we see over time. For accelerating our core business, we are seeing strong and promising results in several areas. In Instagram and Facebook, I'm very optimistic about our work to integrate large language models into our recommendation systems. LLMs add a first principles understanding of what the content is about and why it is compelling, as well as a deeper understanding of what people are interested in and what their goals are when they're using our apps. So this means that we can show more relevant and engaging content that better reflects people's goals and interests. Our new Muse image and Muse video models will also dramatically expand the universe of content that people can discover across our platforms. There are already 2 large sets of content to draw from, first from your friends and the people you follow, and second from creators that you don't follow. But now there's going to be a whole new and nearly infinite universe of personalized content. This is going to make our services a lot more useful and engaging for people. For ads, we are using LLMs to improve how our systems predict and rank the ads that we show. We've expanded the context that we can take into account around a person's organic and ads activity to determine an ad's relevance, driving significant increases in relevance and conversions on both Facebook and Instagram. And on a dollar basis, our ads business is reporting faster year-over-year revenue growth than any other company's reported ad business. So these AI investments are paying off. We are also seeing a lot of demand for our new AI-powered creative tools. 9 million small businesses on our platforms are now using at least one of our AI ad creative tools, and we're rolling out new end-to-end creative solutions that help advertisers translate performance data into their creative decisions. Muse Image is going to supercharge this. The model can analyze images, improve its own work, and produce better ad variations based on advertiser input. We're getting great feedback on this so far. We also just launched Meta One, a new subscription offering that provides more tools and AI features across our apps. As demand grows, we're going to offer a variety of different tiers and pricing options there as well. And I'm also excited about how AI is helping our teams speed up product development. Earlier this year, we shipped Instagram Instants. We also just launched Forum, a standalone groups app, and Seller, a standalone marketplace app. And I expect it to become a lot easier to ship new apps. So we are planning to build out more ideas and use our recommendation systems to scale them to the people who will find them interesting, as we've done with Threads. It's been a little more than a year since we launched Meta Superintelligence Labs, and our trajectory is strong. In the last month, we shipped Muse Spark 1.1 and Muse Image. Since we rebuilt Meta AI and integrated Muse Spark, we have seen a 60% increase in the number of people interacting with the assistant each day, and that continues to grow quickly week over week. Muse Spark 1.1 is a strong agentic encoding model that is very efficient and excels at computer use, tool use, and multimodal understanding. It's available through our new public API, and we are ramping up distribution through partner channels and more coding agents over the coming weeks. We are also building out features to make it easier for enterprises to adopt Muse Spark, and that is an area that we expect to continue focusing on. One reason that we are so focused on making Muse Spark great at agentic capabilities is that we think that there's a very big opportunity to ship a few types of agents that are aligned with our mission and business. The first is personal agents. Soon, we will have agents that can work 24/7 on your behalf to help you achieve your goals and improve your life, your health, your relationships, your finances, whatever you want. The first domain that agents have really taken off in is coding, but engineers are more technical and willing to spend time making those agents work. So to build great personal agents, this needs to be a great consumer product that just works out of the box and is easy enough for billions of people to adopt and use. I'm very excited about this, and we're going to have more to share soon. As we move towards a future where we're all interacting with multiple agents, I think that WhatsApp and our other messaging surfaces are going to become increasingly important. WhatsApp is already the leading surface where people engage with Meta AI. And as we build out a platform for more agents across our messaging apps, we're going to innovate on how to deliver a private and secure AI experience. We launched incognito mode this quarter on WhatsApp and the Meta AI app, allowing people to have private conversations with their assistant that even Meta can't see. We're planning to make strong privacy and security a fundamental part of the agents that we're building as well. I'm also very excited about our progress with business agents. We made Meta Business Agents available globally this quarter on WhatsApp and Messenger, and there are already more than 1 million businesses using them to talk to their customers or complete sales every week. We're rolling business agents out on Instagram now too. One interesting thing about having an agent talk to your customers every day is that it learns over time and can bring all of those insights back to you. So we're building more agentic capabilities to summarize all of these conversations, digest what happened overnight, and surface what customers are asking for. And soon it'll go further, including suggesting ways to grow your business, giving you competitive intelligence and real-time insights into what's working and what's not. And over time, we'd like to build this into a business-in-a-box service that can help you start and run a whole business using Meta's platforms. In terms of how we will monetize these, we have a mix of subscriptions, volume-based pricing, and I expect that we're going to continue to evolve more of these products to be like our ad systems, where businesses only pay us when we achieve results for them. Over time, that will let us run an efficient auction over our compute, similar to how we do that for advertisers today. As AI usage in our products and businesses continues to ramp, we continue to invest aggressively in infrastructure to meet the demand. Yesterday, as part of our Meta Compute effort, we announced a new strategic venture with BlackRock to develop a new 1 gigawatt data center in El Paso, Texas. Overall, we expect that a significant portion of our compute is going to go towards training our models, growing our core business, and delivering personal agents and new products. But we also expect to grow a large business serving large customers as well. We've built our API, we're rolling out business agents, we're getting a lot of offers for compute at a significant premium over what we paid for it, and we have more coding and productivity tools on our roadmap as well. And we'll have more to share on all of this soon. As we get closer to personal superintelligence, we are also going to need hardware that allows you to seamlessly interact with it. Glasses are the ideal form factor since they can be with you throughout the day and they can assist you without pulling you away from the moment. Our glasses remain one of the fastest growing consumer electronics of all time, and we continue adding to the lineup. We just released our own line of Meta glasses in collaboration with EssilorLuxottica, including a style that we designed with Kylie Jenner. They're the first glasses to ship with Muse Spark out of the box so that they can understand what you're seeing and give even more helpful answers. Early sales have been strong, exceeding our expectations, and we're going to have more to share on our glasses lineup at this year's Connect conference on September 23rd, so I encourage you to tune in then. Before I wrap, I want to mention that I just published an op-ed about why I'm so optimistic that we are building a positive future for everyone. At Meta, we have always built technology to put power in people's hands so that they can connect with the people they care about and shape the world in the ways that they want. It's why we've always focused on making our products affordable and accessible for everyone, and it's a strategy that has served both our community and our business well. As we enter this next chapter, that same philosophy is guiding how we approach developing AI. We're the only major company building AI with the primary goal of putting superintelligence directly into people's hands. Rather than centralizing superintelligence, we are focused on distributing it widely and giving everyone the ability to direct it towards what matters to them. That's the way that society has always made progress, I think that these are the right values for building a positive AI future. And if we help build this, then I think that we will continue to build a very strong business as well. So that's everything I wanted to cover up front today. AI is improving our core business. It's making our apps more relevant and delivering better results for businesses. We're starting to deliver more novel products, and we'll have a lot more there soon as well. And we are investing aggressively because the potential is huge, and we know that there are many ways to deliver value here. As always, I'm grateful to all of you for being on this journey with us. And now, here's Susan.
Thanks, Mark, and good afternoon, everyone. Let's begin with our segment results. All comparisons are on a year-over-year basis, unless otherwise noted. Q2 total Family of Apps revenue was $60.4 billion, up 28% year-over-year. Q2 Family of Apps ad revenue was $59.4 billion, up 27%, or 26% on a constant currency basis. In Q2, the total number of ad impressions served across our services increased 14%. Impression growth was healthy across all regions, driven by growth in engagement and users, as well as ad load optimizations. The global average price per ad increased 12% year-over-year, driven by ad performance gains, improvements in macro conditions relative to Q2 of last year, and currency tailwinds. This was partially offset by strong impression growth, particularly from lower monetizing surfaces and regions. For the first time, quarterly Family of Apps other revenue reached $1 billion and grew 73% year-over-year, driven primarily by WhatsApp paid messaging and subscriptions revenue. Within our Reality Labs segment, Q2 revenue was $431 million, up 16% year-over-year due to strong growth in AI glasses revenue, partially offset by lower Quest headset sales. Moving now to our consolidated results. Q2 total revenue was $60.8 billion, up 28% or 27% on a constant currency basis. Q2 total expenses were $42 billion, up 55% compared to last year, and included $2.4 billion in charges related to legal proceedings and $1.2 billion in severance expenses in connection with the May 2026 headcount reduction. Year-over-year growth was primarily driven by increases in employee compensation, infrastructure costs, legal-related costs, and third-party AI token costs. Excluding the previously mentioned severance expense, growth in employee compensation was driven by technical hires we've added over the past year, particularly AI talent. The growth in infrastructure costs was driven by higher depreciation, data center operating costs, and third-party cloud spend. We ended Q2 with over 75,000 employees, down 3% from Q1. This total includes approximately 8,000 employees impacted by the May 2026 headcount reduction. We expect the majority of impacted employees will no longer be captured in our headcount by the end of Q3 2026. Second quarter GAAP operating income was $18.8 billion, representing an 8% decline year-over-year and a 31% operating margin. Excluding the Q2 legal charges and severance expenses, our second quarter operating income would have increased 9% year-over-year. Our tax rate for the quarter was 16%. Net income was $15.8 billion, or $6.18 per share. Capital expenditures, including principal payments on finance leases, were $31.1 billion, driven by investments in servers, data centers, and network infrastructure. Free cash flow was $784 million. We ended the quarter with $90.3 billion in cash and marketable securities and $83.7 billion in debt. Turning now to the business performance. There are two primary factors that drive our revenue performance: our ability to deliver engaging experiences for our community and our effectiveness at monetizing that engagement over time. On the first, we continue to see significant gains from our content recommendation initiatives. On Instagram, global time spent this quarter grew double digits year-over-year this quarter, largely driven by improvements to our feed and Reels recommendations. On Facebook, video time spent increased 9% globally year-over-year, and over 10% within the US and Canada, where it was driven by ranking improvements. We are finding that LLMs are increasingly capable of delivering ranking and recommendations gains. First, they make our existing systems smarter by understanding what the content is actually about and generating better training data. Second, LLM-powered agents are also helping with engineering development by evaluating content quality, detecting trends, and testing ranking changes. Earlier this year, we reached a milestone of every public Reels and feed post on Instagram being automatically processed through an LLM and analyzed across dimensions from topics to tone, and we're working towards including more surfaces on Facebook as well. These signals can then be passed to downstream applications across ranking, recommendations, and content policy enforcement, which is a key building block toward greater personalization. This quarter, we also began using our Muse family of models to conduct content understanding across signals like video topic classification and summarization, and we've seen positive early results. Finally, our recommendations are also becoming more personalized, surfacing more fresh content while giving people more direct control over what they see. On Reels, we shipped our largest single release ranking improvement to date, combining faster inference with a new architecture that draws on deeper user history to improve predictions. This drove a 15 basis point increase in sessions on Instagram, with particular strength in reshares and time spent, which are both strong indicators of better content to user matching. We are now bringing this to feed where early results look comparable. We are also getting new content to people more quickly. Investments we've made in more real-time infrastructure and modeling improvements on new videos are allowing our largest ranking models to now identify high-quality new reels at creation. On Instagram feed, over half of all recommended content is now less than 1 day old, more than double from a year ago. We're also giving people more direct control of the content they see. Today, Instagram users can visit the Your Algo page, which lets users write natural language prompts to tune their recommendations. Similarly, on Facebook, we launched Shape Your Feed. Early results show over 80% retention among users who engage with it. Looking forward, we're executing on our longer-term efforts to develop the next generation of our recommendation systems. This includes building foundation models that are designed to power organic content and ads recommendations simultaneously, as well as developing LLM native recommender systems. We hit our first research milestone this half by continuously pre-training a large-scale model with recommendations data and observing healthy scaling laws in the process. We're encouraged by this milestone and expect continued progress in the second half of the year. Turning to the second driver of our revenue performance, increasing monetization efficiency. The first part of this work is optimizing the level of ads within organic engagement. Here, we continue to enhance our systems to show ads at the optimal time and location. In Q2, we also expanded availability of ads on our newer surfaces, including completing our global ads expansion on Threads. On WhatsApp, we have introduced support for more types of ad destinations and advertiser performance goals in status, and continue on track toward our global rollout. Moving to the second part of increasing monetization efficiency, improving performance for the businesses who use our services. Within our ad systems, we're delivering performance gains as we deploy more complex and predictive models. This quarter, we introduced Meta Generative Recommender, a paradigm shift in how our ad system works. Rather than scoring every possible ad individually, we are now using LLMs to reason about ad content and user preferences together and predict the best ad for each person. This makes our ad matching more intelligent and more precise, which compounds performance gains for advertisers. We deployed the first generative model into our ads retrieval system and saw notable improvements in ads performance. Early pilots using LLMs to better understand user preferences drove a 1% increase in app event conversions on Instagram. In Q2, we also advanced our user understanding models to analyze ads and organic activity and simultaneously improve both user experience and advertiser performance. Combined with our GEM model for ads ranking and sequence learning, these advancements generated an 8.3% increase in ad clicks and a 15.7% uplift in conversions on Facebook. We're also leveraging AI to empower businesses to more easily manage their campaigns, develop ad creative, and engage with their customers. Our AI-powered Advantage Plus end-to-end solutions continue to grow, reaching over $75 billion in annual revenue run rate this quarter. We're working to deepen adoption as advertisers who leverage multiple tools see compounding performance gains. I'll share one example of how Advantage Plus is making performance marketing meaningfully easier and more effective for SMBs. Underneat, an online apparel brand in India, had been setting up each campaign manually across Facebook and Instagram. After adopting Advantage Plus sales campaigns layered with Advantage Plus audience placements and budget optimization, they saw a 13% incremental lift in purchases and a 16% increase in add-to-cart conversions. Adoption of our GenAI ad creative tools continues to scale, with over 9 million small businesses using at least one AI creative tool. Image generation, which now lets advertisers produce more creatives at scale from existing content, including a new ability to create images from video assets, saw adoption more than double this quarter. We also introduced a new end-to-end creative solution that gives advertisers the AI infrastructure to translate real performance signals into their next creative decision, while preserving brand identity and tone. We're building with agency integrations from day one so teams can diagnose, generate, and scale high-performing creative without leaving their existing workflows. Looking ahead with the rollout of Muse Image, we expect to further expand advertisers' ability to generate high-quality, on-brand creatives at scale. With Meta Business Agent, businesses are better able to serve their customers through our messaging apps by responding to inquiries, recommending products, and handling support around the clock. Earlier this month, we also introduced the Meta Business Agent platform, which gives enterprises the infrastructure to build, customize, and deploy their business agent at scale on WhatsApp. The platform provides larger businesses with enterprise-grade controls, guardrails, and measurement built in, so they can define rules and offer personalized experiences, starting within the messaging apps that their customers already use. Movida, one of Brazil's largest rental car companies with nearly 400 locations, deployed a business agent on WhatsApp to handle the entire booking flow, from vehicle selection and pricing to payment, in a single conversation. Returning customers could complete a reservation in as few as 3 messages. In a 1-month period, Movida reported a 44% increase in daily bookings through WhatsApp when compared to the same period in the prior year, and that 85% of conversations in the channel were resolved entirely by the AI agent without human assistance. We're also building out additional ways to monetize our ecosystem. 2 additional revenue streams are subscriptions and monetizing our competitive models through an API. Meta One is an evolution of our subscription portfolio to create more value for everyday users, businesses, and creators, so they get more features and AI tools to create, connect, and stand out. We are excited to bring this to more users and continue to build enhanced tools for our subscribers. We also recently launched a high intelligence model API at a competitive price and are encouraged by the initial results. We recently made Muse Spark available on OpenRouter for US-based developers, broadening its distribution and making it easier for developers to adopt the model. We soon expect to roll out the model API to more distribution channels, make it available in more countries, and open it up for enterprises. Our approach to building capacity is strongly influenced by several key elements. First, the broad environment for building infrastructure is dynamic and uncertain in both near-term and longer-term time horizons. The industry has underbuilt historically for the wave of AI adoption, making existing capacity, including our own, extremely valuable. Longer term, the supply chains need to be built out to support the capacity that we anticipate we and others will need for AI-powered experiences. Second, we have high confidence in our ability to utilize capacity to scale and build on top of our existing experiences, as well as continue to invest in foundational models that will create substantial new opportunities. Consequently, our current plans are geared towards maximizing 2026 and 2027 capacity. When we have had incremental capacity in the past, it has proven extremely valuable in scaling experiences like Reels, and we are confident that this will be true in this timeframe as well. Longer term, it's harder to predict the exact usage scaling curves, but we believe that our distribution advantages will give us the opportunity to serve AI products that are valuable for everyone, both our 3.6 billion users and millions of businesses. This should be true regardless of whether our models are on the frontier, but we believe that being on the frontier will unlock new markets and opportunities for which we may need additional compute. Therefore, our longer-term capacity strategy aims to give us the flexibility to continue growing compute in 2028 and beyond by laying down data center and network foundations to accommodate future server decisions. The long-lived nature of these assets inherently provides the flexibility that will make it possible to adjust our investment to the pace of AI adoption. In addition, we have been making strategic investments in areas like our internal custom silicon effort, which will provide long-term strategic flexibility and supply chain leverage. This will be helpful in driving better returns on those long-term investments. Finally, we believe that overall industry capacity is going to remain tight for the foreseeable future. As we've said earlier, we strongly believe that the models, consumer experiences, and enterprise offerings that we are building will be the best and highest ROI use of our infrastructure. Those enterprise offerings have the potential to take multiple forms, as Mark mentioned, agentic tools, our API, or monetizing compute directly given outsized market demand. We expect that remaining nimble about these opportunities will help us fund our build-out more efficiently while preserving our strategic flexibility to have the compute when we need it and provide us multiple pathways to generate returns on invested capital. In funding these infrastructure investments, the strength of our balance sheet gives us the ability to attract capital from a wide range of markets to supplement the cash flow generated by our business. Our announcement with BlackRock yesterday is an example of the partnerships that we can structure to complement our approach to building infrastructure capacity. Moving now to our financial outlook, we expect third quarter 2026 total revenue to be in the range of $61 to $64 billion. Our guidance assumes foreign currency is an approximately 1% headwind to year-over-year total revenue growth based on current exchange rates. Turning to the expense and CapEx outlooks. We are raising the lower end of our expense outlook to incorporate the $2.4 billion charge related to legal proceedings recognized in Q2. We now expect full year 2026 total expenses to be in the range of $165 to $169 billion. We continue to expect to deliver operating income this year that is above 2025 operating income. We anticipate 2026 capital expenditures, including principal payments on finance leases, to be in the range of $130 to $145 billion, narrowed from our prior outlook of $125 to $145 billion. Absent any changes to our tax landscape, we expect our tax rate for the remaining quarters of 2026 to be between 15% to 17%, an increase from our prior outlook of 13% to 16%. Finally, we continue to monitor active legal and regulatory matters that could significantly impact our business and financial results. For example, we continue to see scrutiny on youth-related issues in several markets and have a number of youth-related trials scheduled for this year in the US, which may ultimately result in a material loss. In closing, our business momentum continued in Q2 with strong execution across our core ads and engagement initiatives. We're also progressing in our efforts to bring personal superintelligence to everyone with exciting model releases, and we expect to build on that momentum over the course of this year with new products. With that, Krista, let's open up the call for questions.
Thank you. We will now open the lines for a question and answer session. To ask a question, please press star 1 on your touchtone phone. To withdraw your question, again, press star 1. Please limit yourself to one question. Please pick up your handset before asking your question to ensure clarity. If you are streaming today's call, please mute your computer speakers. And your first question comes from the line of Brian Nowak with Morgan Stanley. Please go ahead.
Thanks for taking my questions. I have two, one for Mark, one for Susan. Mark, I appreciate all the color on the big pipeline for new products across consumer and business agents, API tools, and compute rental. There's a lot of opportunities here. But my question is, as you look at these opportunities and the state of the current offerings, the compute capacity, which of them do you expect to be able to scale first, sort of in 26 and 27 to sort of showcase quantifiable material ROIC for investors? And then Susan, there's been some public comments about capacity in 27 and doubling capacity, and I appreciate your color about CapEx. Any early comments on 27 CapEx, even the philosophy around sources of upside or sources of downward pressure, just sort of think through different ways to finance this multi-year build and have 27 CapEx?
I can take the first one. So in terms of the different opportunities and how we think about the compute, overall, a substantial amount of the compute goes towards training models to be a leading lab. And I think that that's an important investment. But then the rest of it goes towards a set of different products and revenue opportunities, which spans from optimizing and improving our core business to building new consumer products that we're releasing soon, to the API, to the business agents work, to the developer tools work on the roadmap that I alluded to, and then also the opportunity to sell compute directly. Where I mentioned that we have quite a number of offers at a meaningful premium over what we paid for the compute. The question in thinking about this is, we believe that there will continue to be a significantly higher margin on selling intelligence rather than selling compute directly. But we think that there's a big opportunity, obviously, to sell compute as well. So we're thinking through. I think you asked what one area would likely scale the most, but I mean, I'm actually quite optimistic that we're going to see meaningful growth in all of these areas, and I think we will have more to share soon on a number of them.
Brian, on your second question, we aren't providing a specific outlook for 2027 CapEx at this time. Infrastructure planning remains highly dynamic, and even this year, there are a range of outcomes embedded in our outlook. I alluded in my main remarks to our focus on gearing our current infrastructure plans towards maximizing capacity in 2026 and 2027, and giving us the flexibility to continue to grow in 28 and beyond, but also giving us the ability to make server decisions, when we come to our being able to evaluate our actual needs in 28 and beyond. So we're still working through what our capacity needs are going to be over the coming years. Generally, we believe near-term capacity is more valuable than long-term capacity, and it remains a very dynamic planning process.
Your next question comes from the line of Eric Sheridan with Goldman Sachs. Please go ahead.
Thanks for taking the question. Maybe two, if I can. When you frame up the enterprise opportunity, how much of that opportunity do you think is available to you today based on what you've built out in terms of go-to-market strategy as extensions of the advertising and the marketing business you have already versus go-to-market strategies that might have to be built to capitalize on the opportunity? And then maybe, Susan, if I could just squeeze a second one in. When you think about sources of capital for the business for the next couple of years, you referenced the deal that was announced yesterday as an example of looking at ways to finance forward obligations. We continue to get questions from investors about how to think about the mix of debt and equity and sources of capital. Philosophically, how are you guys thinking about wanting to be ambitious on the spend, but then marrying that with the need for capital? Thanks so much.
Sure, I could talk about the first part. I think for enterprise, there's going to be a combination of extending the current business, which is effectively selling to marketers and businesses that are like basically customer facing, trying to reach customers and sell to them directly. Obviously that's the vast majority of the business across Facebook and Instagram. And we believe that there's an opportunity to extend this with business agents across messaging apps and other surfaces to continue to interact with customers. And just like the ad system, effectively, we will get paid when we deliver results for those businesses. So we view this as an extension of the sales and the partnerships that we have with many millions of advertisers and hundreds of millions of small businesses that use our platforms. So that one, I think, should be quite a natural opportunity for us. And we're focused on delivering it in a way where we're not trying to kind of maximize the sale in the near term. We're trying to maximize the results for people and build out a robust auction. And that's what we've seen has served the business well over time. There are other enterprise customers who I think we're increasingly going to serve too. We're building coding and developing an internal productivity tools partially because we need to build them ourselves. And we need to make sure that we have tools that are tuned for ourselves. And now that we have those, we feel like there's a large opportunity to serve, whether that's small businesses or larger businesses that is a somewhat different muscle than we have historically had, and we will share more soon on how we're planning to build that out. But I think that there is just a very large opportunity on this. And the way that I think about this is there's obviously been a bunch of news about the compute side, but I think that the enterprise opportunity is kind of the sum of all of these different things. It's not just the selling compute, also the API services, the productivity services, the kind of business agents for other parts of the business beyond marketing are all parts of the overall offering. And I think that there's just a very, very large opportunity there. So we're quite focused on that. That's going to be somewhat of a new muscle that we build as a company, but I think it's a very important one that we build so that way we can make sure that we can maximize the opportunity ahead of us.
Eric, on your second question, in terms of sources of capital, this is something that we have been looking at thoughtfully as we think about financial planning for the future. Obviously, our strong operating cash flow certainly has put us in a position of strength as it pertains to funding our infrastructure build out. But we've also been evolving our capital structure in recent years to include a greater mix of debt as we work to bring down our cost of capital. And we have generally found it prudent to continue adding cost-efficient, long-duration sources of capital as we make investments in initiatives that themselves have long time horizons, especially AI infrastructure projects. We've also broadened our aperture there to include partnerships like the one we announced with BlackRock yesterday. And we'll continue to be thoughtful about evaluating the appropriate different sources of capital over time as we evaluate future projects.
Look out 5 years from now, for example, that whatever period of time you want, that you don't have billions of people with a personal agent that understands your goals and that is just working on your behalf 24/7 to achieve your goals, and whatever the domain is that you care about, whether it's helping you with your health or your hobbies or your personal finances or your productivity and running your home better, or improving and enhancing your relationships, helping with your career, helping like just all these different things. This is like a very, very deep set of use cases. But like you said, I think that building for consumers is a little bit different than building for developers. If you're building for consumers, especially if you're trying to build something that isn't used by millions of people, but is used by billions of people, it needs to just work, right? It needs to be simple. And I think a lot of what we see with these agents today, a lot of the kind of proto agents is, it takes a bunch of fiddling. You have to get into a terminal to get it set up. You get a use case going. It kind of seems magical, but then maybe it breaks down over time. And I think that the companies that can deliver the personal agents that just work, I think that this is going to be one of the next major opportunities in AI. And we are very excited about that, in addition to what we're doing with Meta AI, in addition to what we're doing with business agents, in addition to all these other things, while also developing the models that we think are going to continue to advance new capabilities to create new product lines as well. So this is why we're very optimistic. Now, I get, we're going to ship this at some point soon, and that's going to be very exciting. And we haven't done that yet. So, so this is, there's kind of only so much that I can say on an earnings call about this, but I think this is a very large opportunity, and one that I think is almost inevitable that someone does, and I think it really plays to Meta's strengths as a company. We build consumer products that reach billions of people. We're great at, once we get something working, scaling it to a large number of people, and we're good at building the infrastructure to be able to support these intensive applications. So I feel very good about this. I kind of understand that we need to deliver it for our community, and that's what we're very focused on.
Your next question comes from the line of Doug Anmuth with JP Morgan. Please go ahead.
All right, guys, I think that's good enough as far as the earnings call. We heard a lot of good information on there. Just to wrap things up, I just want to take a look at the actual presentation with slides on it, and then we'll wrap things up. So let's go ahead and do that. All right, Meta earnings presentation Q2 2026. This is advertising revenue by user geography. So we can see that advertising revenue was 59.3 billion this quarter. That compares to 46.5 billion in the same quarter last year. So a very nice increase in advertising revenue. And still the US and Canada segment is the highest, followed by Europe, then Asia Pacific, and then rest of the world. So nice looking growth chart here as far as advertising revenue each quarter. So let's take a look at the overall revenue, total revenue. All right, so we can see that the revenue this quarter was $60.8 billion. That compares to $47.5 billion in the same quarter last year. So that's a really good increase in revenue. And every quarter, basically, revenue just keeps going up. So that's good to see as well. Expenses as a percentage of revenue. So we can see that this quarter, Q2 2026, expenses as a percentage of revenue is the highest from any of these quarters. So that would be the increase in capital expenditures that the company is deciding to do. But still, it's not much higher than before. So I'm sure it's going to pay off in the coming quarters. This is effective tax rate, net income, earnings per share, capital expenditures. We can see the significant increase in capital expenditures. Q2 2025 was 17 billion. This quarter it's 31 billion. And for last year it was 30 billion. This year is over 50 billion. So the capital expenditure numbers are definitely going up. Family daily active people. This is still, growing somewhat, so that's still really impressive to see. Average revenue per user, and that's going up. Average price per ad, year-over-year percentage change. So they're making more money per each ad, so that's good to see. All right. All right, guys, I think that's all I wanted to share as far as Meta's Q2 earnings report. So Meta reported their results today. The stock is down in the after-hour session. Even with really good results, the company didn't meet expectations on a few metrics, and thus that sent the stock down even further. So we'll see what happens in the coming days. I'm sure the stock will rebound and recover, but a little bit of a disappointing result. And again, we'll see what happens in the coming days. All right, guys, I really hope you enjoyed today's show. If you did, again, subscribe to my YouTube channel so that I can continue making these videos. Hit that like button and make some comments on your reaction to Meta's Q2 earnings, the stock price, and anything else you want to share. That's it for me. See you guys next time. Take care.